There is a number that has quietly become the most terrifying figure in Florida real estate. In 10 specific Florida towns, the number of insurance companies willing to write a policy on your home is 0. Not 1, not 2, 0. What does it mean when the entire private insurance industry looks at a community and says we're out? Not a temporary glitch, not a bureaucratic delay. What's happening in these communities is far more structural, far more permanent, and far more consequential than most people buying or selling homes in Florida understand. By the time you finish watching, you'll see the Florida real estate market in a way that cannot be unseen. And if you own property in one of these 10 towns, or you're thinking about buying there, this may be the most important video you watch this year. Here's the first thing to understand. When private insurance disappears from a community, it doesn't just mean homeowners pay more. It triggers a cascade. Property values fall, lenders pull back, buyers evaporate, and a neighborhood's economic foundation begins to erode. Slowly at first, then all at once. We'll walk through 10 Florida towns where that cascade has begun or is accelerating right now. We'll look at the data, the people living through it, and answer the question the real estate industry won't answer clearly: why is this happening? The official explanation that hurricanes are getting worse is only half the story. The other half is something insurance executives have known for years and only recently started saying out loud. We'll get to that. But first, where it's most visible. Picture Matlacha, Florida. It's a small fishing village on Pine Island, connected to Cape Coral by a single 2-lane bridge. The houses are painted in faded pastels and sit on stilts above the water. On a calm morning, the place looks like a postcard that time forgot. Artists moved here decades ago because the rent was cheap and the light off the water was extraordinary. By 2021, median home prices had climbed past $400,000. Then Hurricane Ian made landfall on September 28, 2022, a Category 4 storm with sustained winds of 150 miles per hour. Ian's eye passed almost directly over Pine Island. Matlacha was devastated. The bridge was destroyed. Homes were reduced to their concrete pilings. The rebuilding is still ongoing. But here's what happened after Ian that nobody talks about enough. Within 18 months of the storm, 7 private carriers writing policies in Lee County either went insolvent, withdrew from Florida entirely, or stopped writing new coastal policies. For Matlacha, homeowners who survived Ian, replacement coverage became nearly impossible. The quotes they did receive, from the few carriers still willing to engage, came in at $18,000 to $24,000 a year for a modest 3-bedroom home. That's a monthly insurance payment higher than many people's mortgages. Most of those homeowners ended up on Citizens Property Insurance, Florida's state-backed insurer of last resort. And that phrase is doing a lot of work. Citizens exists precisely because no one else will take the risk. It is, by design, what you get when every other option has said no. And once a town tips fully onto Citizens, it has crossed a line that is very hard to come back from. Matlacha is town number 1. But to understand why it's there and why 9 other towns share the same fate, we need to look much deeper than one hurricane. Insurance, at its core, is a BET. The company bets your house won't burn down or flood or blow away. You bet that it will. The premium is the price of that bet, calibrated to the probability of loss. For most of American history, that calibration was stable, built on decades of historical data. What broke that system in Florida, specifically in these 10 towns, is something climate scientists call loss acceleration. The losses aren't just getting bigger. They're getting bigger faster than the models predicted. The models were built on a world that no longer exists, and the people relying on those models were the last to admit it. Between 2000 and 2010, Florida averaged $3.2 billion in insured losses per year from weather events. Between 2017 and 2023, that figure jumped to $14.7 billion per year. That's not a trend, that's a transformation. And the private insurance industry responded the way any rational business would to a bet that keeps going wrong. They stopped making it. Now here's where it gets more complicated, and this surprises almost everyone. Hurricanes alone don't explain everything. They explain the coastal towns, but some communities on our list aren't coastal at all. Consider Lake Wales, a small city of about 17,000 people in Polk County, in the geographic center of the state. No ocean, no bay, no inlet, about as far from the coast as you can get and still be in Florida. And yet insurance carriers have been retreating from Polk County for 3 consecutive years. The reason is sinkholes. Polk County sits on limestone bedrock that has been dissolving for thousands of years, creating a honeycomb of underground voids beneath the surface. Florida has more sinkholes than any other state, an estimated 2,000 new ones reported annually, and Polk County is ground zero. In Lake Wales, sinkhole claims tripled between 2019 and 2023. A home with no visible damage can suddenly drop 6 inches in a weekend. Foundation walls crack, pools tilt, and remediation filling those voids with grout under high pressure routinely runs between $50,000 and $150,000 per incident. Insurance companies started excluding sinkhole coverage years ago. But even without paying sinkhole claims, carriers are still on the hook for the structural damage sinkholes cause. The legal distinction between sinkhole damage and catastrophic ground cover collapse has been litigated for decades, and insurers have lost enough cases that many decided the region isn't worth the exposure. Lake Wales is town number 2, and the residents there will tell you something interesting. They feel forgotten. The insurance crisis is discussed almost exclusively in coastal terms: Miami, Fort Myers, the Keys. But the people of Lake Wales are paying $6,000, $7,000, $8,000 a year for coverage that explicitly excludes the most likely thing that will damage their homes. That's not insurance. It's a FEE for a document that might not help when you need it most. Let's move south to Evergladescity, a town of fewer than 500 permanent residents at the edge of the Big Cypress National Preserve. It is one of the most remote communities in the continental United States. 1 road in, 1 road out. The nearest hospital is 35 miles away, and the median home price, improbably, is $312,000. Evergladescity sits 3 feet above sea level, 3 feet. With sea level rise projections for South Florida ranging from 10 to 17 inches by 2040, that number is not a statistic, it's a countdown. Private insurers began withdrawing from Collier County's coastal zones in 2021. By 2023, Evergladescity had effectively no private market. Citizens property insurance is the only option, and Citizens itself is under enormous pressure to raise rates to reflect actual risk. A 2023 legislative reform package allows Citizens to raise premiums up to 15% annually, a cap that sounds modest until you do the math. At 15% per year, a $4,000 policy becomes $8,000 in 6 years. That $8,000 policy becomes $16,000 6 years after that. For the fishing families and retired couples who have lived in Evergladescity for generations, this is existential, not a financial planning question. An existential one. Town number 4 is Yankeetown, a tiny community of about 600 people on the Gulf Coast in Levy County, where the Withlacoochee River meets the sea. It is one of the lowest elevation communities in Florida that isn't a major metro, which means it gets almost none of the political attention and almost all of the flood risk. National Flood Insurance Program rates here have risen an average of 40% since FEMA's risk rating 2.0 methodology in 2021, which for the first time prices flood insurance on a home's actual replacement cost rather than just its flood zone. The result for Yankeetown homeowners was sticker shock many called incomprehensible. One resident, a retired schoolteacher named Dorothy Sims, told a local reporter in 2023 that her flood insurance premium went from $1,800 a year to $4,400 in a single renewal cycle. Her home is worth $190,000. She is 71 and on a fixed income. She dropped the flood coverage. She is now, in the language of the industry, naked. A homeowner with a mortgage and no flood insurance in a community with a documented flood history. Her lender hasn't noticed yet. When they do, they will force place insurance at a rate even higher than what she dropped. This is how the cascade begins. One school teacher, one impossible decision, one policy lapse multiplied across hundreds of households in dozens of towns. If you followed the thread this far, you're already paying closer attention to Florida than most people who skim the headlines. Whether you own a home here or you're planning the move, the next several towns are the part you need to hear, because this is where the story stops being 10 separate towns and becomes one single system. Stay with me. Towns 5 and 6 sit in the Florida Panhandle, Mexico Beach, and portstjoe, two Gulf County communities essentially erased by Hurricane Michael in October 2018. Michael made landfall as a Category 5, the first Category 5 to hit the continental United States since Andrew in 1992. The storm surge in Mexico Beach reached 14 feet. 14 feet of water moving at speed through a residential neighborhood. The before and after satellite images look like a special effect. They are not. Both communities have been rebuilding for 6 years. New construction has gone up, some of it extraordinary, elevated, reinforced, built to code. But the insurance market for Gulf County remains deeply distressed. Carriers that returned after Michael left again, once later storm seasons proved the Panhandle's risk profile had been permanently repriced. Storm surge vulnerability, aging housing stock rebuilt cheaply after Michael, and the sheer frequency of Gulf-facing storm exposure have made Mexico Beach and portstjoe effectively uninsurable through the private market for any home that doesn't meet the strictest post-2018 building standards. Town number 7 is Pahokee, on the southeastern shore of Lake Okeechobee. This is a different kind of crisis. Pahokee is a low-income agricultural community, sugarcane country, where the median household income is about $28,000 a year. The crisis here is not hurricanes or sinkholes. It is what insurers call market profitability thresholds. In plain language, when the average home is worth $95,000 and the cost of underwriting and servicing a policy is roughly fixed regardless of home value, the math does not work for private carriers. The premiums they'd need to charge would be such a large share of the home's value that regulators would challenge them. So carriers simply do not write policies in Pahokee and have not for years. The residents there have lived without meaningful private insurance longer than the current crisis has been making headlines. Their abandonment simply happened too quietly, in a town too small, for anyone outside it to notice. This is the part that rarely gets told. The insurance crisis in Florida is not only a coastal crisis, it is also a poverty crisis. The communities with the least political power and fewest economic options are often the ones most completely abandoned by the private market. Town number 8 is Horseshoebeach, another small Gulf Coast community in Dixie County, population around 200. It has the kind of beauty that makes people drive 2 hours off the interstate to see it: clear springs, undeveloped shoreline, old Florida, before it was paved over. It also has a FEMA flood map placing virtually the entire community in a special flood hazard area. When FEMA's risk rating 2.0 recalculated flood premiums in 2021, Horseshoebeach saw some of the steepest increases in the state. Several properties saw annual flood premiums exceed $10,000. For homes valued at $150,000 to $200,000, that's 5% to 7% of the property's total value every year. No rational financial model supports that. And so, one by one, owners have let their flood policies lapse, leaving a community insured on paper through Citizens for wind, but unprotected from the one risk most likely to destroy their homes. The next major storm will find that out for them. Before the final 2 towns, here's something worth having if you own property in Florida or you're weighing a move here. Every town worth buying into and every town worth avoiding in this state is now in one place. It's a breakdown of 40 Florida towns, 20 rated to buy and 20 rated to avoid, in a single guide called the Florida Buy and Avoid List for 2026. You can get it through the link in the description below. But stay right here, because the question this whole video has been building toward, what happens when Citizens itself runs out of money, is the part almost nobody is talking about, and it's next. Town number 9 is Steinhatchee, also in Taylor County on the Gulf Coast, a fishing community that took a direct hit from Tropical Storm Idalia in August 2023. Idalia made landfall as a Category 3 hurricane near Keaton Beach, just miles away. The storm surge reached 7 to 9 feet in some areas. Steinhatchee had struggled with insurance availability for 2 years before Idalia. After the storm, it became acute. Several carriers writing policies in Taylor County announced non-renewals within 90 days of the storm, before the claims were even fully processed. This practice has become increasingly common. Carriers exiting a market immediately after a loss event before state regulators can impose a moratorium on cancellations. It is legal. It is deliberate. And it leaves communities in exactly the position Steinhatchee is in now, a town full of damaged homes in active recovery with no private insurance market to return to. Town number 10 is Flaglerbeach, a small coastal community in Flagler County between Daytona Beach and St. Augustine. It has been fighting chronic beach erosion for decades. The A11A highway through town has been damaged by storm surge so many times that the state has essentially accepted portions of it must be relocated inland. But the homes on the ocean side of A11A, many worth $400,000 to $700,000, are now in a category of risk private insurers have decided is simply unacceptable. The erosion data is unambiguous. The beach in some sections is retreating 3 to 4 feet per year. In a decade, some of those properties will be measurably closer to the water. In 2 decades, some may be in it. Actuaries can read a map, and what they see in Flagler Beach, they don't like. Now here's the question all of this raises, building since the first minute of this video. If private insurance is retreating and Citizens is the insurer of last resort, what happens when Citizens itself becomes overwhelmed? This is not a hypothetical. Florida's Office of Insurance Regulation has warned repeatedly that a major hurricane striking a densely populated area, a direct hit on Tampa Bay, which hasn't seen a major storm since 1921, could generate insured losses that exceed Citizens' reserves. In that scenario, Citizens has the legal authority to levy assessments on virtually every insurance policy in Florida, auto, home, and commercial to cover the shortfall. Every Floridian with any insurance policy could be billed for a storm that didn't touch their county, their city, or their street. That is the hidden architecture of the Florida insurance crisis. The risk doesn't disappear when private carriers leave. It concentrates. It moves from the spreadsheets of private companies into the public system. And when the public system is stressed beyond capacity, the cost spreads across the entire state to every policyholder who assumed they were insulated from a problem in someone else's town. Think about Dorothy Sims in Yankeetown making an impossible decision about flood insurance she can no longer afford. Think about the artists in Matlacha watching their insurance quotes arrive like ransom notes. Think about the fishing families of Steinhatchee, rebuilding after Idalia in a market that has already decided to move on without them. These are not isolated stories. They are early data points in a transformation of the Florida real estate market that is only beginning to be priced in. The communities on this list didn't end up here because of bad luck. They ended up here through a collision of geography, climate trajectory, actuarial mathematics, and political choices made over decades about where to allow development, how to price risk, and who would be protected when the math stopped working. The insurance industry didn't create the risk. It just stopped pretending it wasn't there. And the moment they stopped pretending, the cost of that honesty landed entirely on the homeowners. And that brings us back to the number we started with. 0. The number of private insurers willing to write a policy in these 10 towns. That number is not an accident or an anomaly. It is the answer to a question the market has been quietly calculating for years. What is the true unsubsidized price of owning property where the odds have finally been calculated honestly? The price of a Florida home has always included an invisible subsidy, the assumption that insurance would be available, that risk would be distributed, that the system would hold. In these 10 towns, that assumption has been revoked. So here's what I want to hear from you. Tell me in the comments which Florida town you live in or which one you're planning to move to, and what your insurance renewal did to you this year, because the numbers you share shape the next video. And tell me what you want covered next. If you believe the real story of this market is the one the headlines keep skipping, hit the subscribe button right now, because next we're tracing which Florida towns are about to join this list. The communities that still have private insurers today and have no idea the carriers are already preparing to leave. The question now is not whether other Florida towns will join this list, it's which ones and how soon. We'll see you in the next one.